Today, we're talking about beating the S&P 500 and how sometimes that can lead to you not achieving your goals. So why are we talking about the S&P 500? Well, we're using the S&P 500 because that is a benchmark that many investors use to determine, hey, am I doing well with my investments? Am I doing poorly with my investments? Sometimes they use the S&P 500 as a benchmark and say, well, am I beating the S&P 500 or am I trailing behind the S&P 500? And you might think to yourself, okay, if I'm beating the S&P 500, I'm probably doing pretty well with my investments. And today we're going to dig into a chart, look at history, and say, while sometimes it's the case, there are quite a few situations where beating the S&P 500 may actually lead to not ideal outcomes for your finances. So let's get started with this chart. So what this is showing us is the 10-year rolling returns for the S&P 500. So what does that mean? It means the average return over the course of 10 years, and it goes all the way back to the 30s. And so each one of those vertical bars represents a 10-year average rate of return given different starting periods. And as you can see, if you started investing in the mid-1930s, that's the Great Depression. Things didn't look great. Then they got better in the 50s, worse in the 70s, better in the 80s and 90s. There was the 2008 crash, and here we are. And this blue line just kind of gives a trend pattern, right? Things go up, things go down. And this orange dotted line across the middle, this is going to give us our long-term average. The long-term average rate of return in the S&P 500 is 10.32%. Now you might be thinking, Kyle, if I return more than 10.32% in my portfolio on average, I am doing great. And that's correct. You would be doing great if you did better than the average of the S&P 500. But we're not using the average return of the S&P 500 as the benchmark. We are using the year-to-year performance of the S&P 500 or the 10-year average. Let me tell you what I mean by that. So if you were to return, let's say, for example, 12% in your portfolio and the market or the S&P 500 returned 10.32, you might feel pretty good about it. You would say you did well. We're not going to talk about beating the S&P 500 in its up years, these big peaks where the S&P has done great for an extended period of time. Clearly, your long-term goals could be on pretty well tracked if you're doing better than the S&P 500 during these time periods. What we are going to talk about is what happens during these troughs. What happens when the S&P 500 has had extended down periods, and what does it mean to outperform during these time periods? So let me give you a couple of examples. The Great Depression is a bit extreme, but let's just use the 2008 crash. So if you would have been an investor and started investing in 2007, well, your average rate of return in the S&P 500 over the next 10 years would have been negative. It would have been below zero. And so my question is, if the average rate of return in the S&P 500 was -1 for 10 years, and you returned, let's call it 0 for 10 years, technically you beat the S&P 500 over 10 years. But the question is, do you feel good about your performance? Do you feel confident in your portfolio? And the answer might be no. In particular, if you're a long-term investor and you're looking at creating a retirement income stream with your portfolio, having a 0% rate of return, while it is outperforming the market, the S&P 500 technically, you might very well fail to achieve your goals if you are solely tied to the S&P 500 and solely tied to beating the S&P 500. So as you can see, sometimes beating the S&P 500 up at the top is great news. Sometimes beating the S&P 500 doesn't mean anything because really, what is the benchmark that long-term investors should be using? So the S&P 500, it's on the news every day. It's easy to talk about. It's with companies that you know and use throughout your life. So it's common. People can talk about it together and say, hey, how are we doing? Well, it's on the news every day how you're doing compared to the S&P 500. But why isn't that a great benchmark to use? Well, because when you're creating a long-term plan, the benchmark that matters is your benchmark. What do you need to achieve the goals that are most important to you, most important to your family? So whether the S&P 500 is up 10, down 10, up 20%, beating it or falling behind it doesn't really matter in the context of what do you need to be successful with your finances and with your long-term investment plan. And so this leaves us with the question, well, what rate of return do I need to be successful? And in order to find that, you need a plan that basically says, again, where am I now? Where do I want to be in the future? What do I need to get there? And then you need to build the portfolio around the plan. So rather than start with the portfolio, start with the plan. That will drive the way that your portfolio is allocated and whether or not beating a benchmark or underperforming a benchmark matters at all. I hope you found this helpful. And as always, thanks for investing your time with the Personal CFO.